Hi, good morning, everyone, and thank you so much for joining us here today. My name is Weiren, part of the research team in iFast, and today the focus of my presentation is going to be on our market outlook and how investors should position their portfolios in the second half of 2025. And one of the key questions that I'll be addressing in my sharing today is whether the world is entering a Sell America era. And this is a very important question. Why? Because the US has dominated global stock markets over the past few decades. But in 2025, this year, unfortunately, the US has actually massively underperformed the rest of the world. And just to give you a sense of how dominant the US has been, you can have a look at this chart. The blue line here represents the performance of the S&P 500. Orange line represents the rest of the world. And you can see very clearly for the past 30 years, from 1994 to 2024, US equities have consistently outperformed non-US equities. And if you look at its total returns, the S&P 500 has delivered an annualized return of 10% compared to just 5.1% for non-US equities. And such is the dominance of US equities that for many young investors, I don't see many young faces here, but for those of you who are maybe in the younger generation, it's probably hard for you to recall a time when the US is not dominant in global markets. So the US has been dominant for the longest time. Unfortunately, the dominance that we have seen over the past few decades, it was nowhere to be found in 2025. If you look at this chart right here, which shows you the year-to-date performance of selected equity markets, in the first 6 months of this year, the S&P 500 is actually down by 1.2% in Sing dollar terms. And on the other hand, you can see the rest of the world is actually doing a lot better. Non-US equities, they are up by 10.1% this year. While you also have other markets like Europe and China, these markets have also delivered far superior returns of 15.8% and 9.3% respectively. Now, it's actually not unusual to see US markets underperforming from time to time. It has happened in the past, but the underperformance this year has been particularly striking given the magnitude of the underperformance and also the fact that the rest of the world seems to be doing a lot better than the US, which is something that we rarely see in financial markets. So again, are we entering into the Sell America era? I think it's difficult to draw any firm conclusions from just 6 months of performance. But what has happened this year is that investor confidence has definitely been shaken. And barely a year into Donald Trump's second presidency, he has already changed the world significantly. And there will, of course, be huge implications for all investors. Now, the biggest change that Donald Trump has brought about in his current presidency is a change in the world order. Before Trump took over as president, the world was not perfect. It was not perfect, but it was at least rules-based. There were clear rules governing international trade. There were well-functioning global institutions that encouraged international cooperation. And central to this system is the US, because they were the ones who created this current world order. And they were, of course, willing to sustain it because they truly believed that it strengthened the US as one of the world's leading superpowers. But Trump thinks quite differently. Trump has a very different mentality. Trump thinks that the current world order is an obstacle that limits America's ability to act on its own. He thinks that the whole world is ripping America off. That is Trump's mentality. And that is also the reason why Trump has been aggressively withdrawing America from its international obligations. And he has also abandoned his allies. He has taken a very transactional approach in his foreign policy. So this significant shift in America's position on the world stage has actually prompted the rest of the world to start diversifying their trade partners, form new partnerships, and also to pursue reforms in order to boost their growth and economic resilience. Now, Europe is a very good example. After Trump was re-elected, Europe has immediately started to resume long-delayed trade negotiations with a lot of countries. Okay? And it has also started to ramp up its defense spending. And in a clearest sign that Europe is urgently diversifying away from the US, its trade talks with South America has taken on added, its trade talks with South America is a very good example of how urgent it is for Europe to diversify away. Because its trade talks with South America has actually been dragging on for 25 years. But the moment Trump came in as president, the moment Trump started threatening the whole world with tariffs, the trade talks with South America was finalized in just a matter of months. So you can see, actually, Trump is very powerful. The moment he comes in, something that took 25 years to resolve has taken just 6 months to wrap up. That is Trump's power. He has been a huge catalyst for change in the rest of the world. And it is not just in Europe, in China as well. For the past 5 years, China has been busily cracking down on its tech companies and its private sector. But it has also started to realize its mistakes in recent times. It is now realizing that its private sector is actually very important towards an economic recovery. And with Trump now in the White House and specifically targeting China, the task of reviving China's private sector has now become even more urgent. So moving forward, as we enter into this new world order, what is going to happen is that as the US retreats from its global responsibilities, other countries will likely step in to fill the void. And the likely outcome for this is that the global economy will become more balanced, with Europe and Asia likely taking on more responsibilities for driving growth and also for taking on international leadership. And what this means for all of us investors is that diversification has now taken on added importance in our portfolios. Now, when I say diversification, I'm actually referring to diversification away from the US. So in this new world order, where the US is retreating and other countries taking on more responsibilities, there is a good reason for us to consider greater diversification away from the US. Now, there's also another reason why you should diversify. It is simply because the near-term prospects of the US equity market is actually not looking so positive. Our base case for the US economy is for it to enter stagflation in the second half of this year. Slowing growth, but accelerating inflation. And a key part of our investment thesis is really because of tariffs. We expect elevated tariffs to remain in place. Yes, I know there are trade negotiations going on right now. We also acknowledge that there is a possibility that tariff rates could come down significantly after the conclusion of those negotiations. But having said that, even if there is a positive outcome from these trade negotiations, tariff rates will still be at record high levels. It is still going to be significantly higher than the 2 to 3% that we have seen over the past few decades. And in fact, we expect tariff rates to settle somewhere between 10 to 20% by the end of this year. And with tariffs at this kind of levels, inflation is likely to pick up. And if inflation does pick up, consumption will suffer. Businesses will also likely to delay their investments and hiring, not just because of the economic uncertainty, but also because of the uncertainty surrounding the tariffs as well. Trump could change his mind depending on his mood. That's one area of uncertainty. And there is also the legal issues surrounding the tariffs. Nobody is sure whether Trump really has the authority to follow through on his tariff threats. And if you are the business owner, if you are faced with such uncertainty, what do? You will wait and see. And that is what most businesses will do in America. So this is going to affect the US economy. And in the absence of a significant rollback in tariffs, our base case right now is for the US to enter stagflation in the second half of this year. Will the Federal Reserve then come in to rescue the economy? I think it's also very unlikely, because high inflation also means that the Fed is unlikely to cut interest rates aggressively this year. So a weak economic outlook for the US, it also means that the earnings of US companies will likely be affected as well, especially those in industries that deal with goods and manufacturing, because they are the ones who will experience the most negative consequences from higher tariffs. Which is why in recent times we have actually downgraded our view of the US equity market, and we have recommended investors to adopt an underweight position for the US. But even as we have downgraded the US, I think there are still bright spots that you should take note of, and the tech sector is one of them. Because the earnings for tech companies, they are anchored and driven more by long-term structural trends, such as the increasing digitalization of the global economy and the AI revolution. So their earnings are going to be more resilient, and recent earnings reports have also pointed towards a strong and robust AI demand. And this is also going to support their near-term earnings outlook as well. So within the US, our recommendation is to favor high-quality stocks within the digital economy and semiconductor industries. Outside of these two industries, unfortunately, we see very limited opportunities. And for those investors who have a very US-focused portfolio and you are looking to diversify away from the US, we have a couple of recommendations with Europe, China, and Japan. Now, Europe has been one of the main beneficiaries of the US stock market decline this year, primarily because it's the next largest developed market after the US. So when global investors get out of the US market, the next place that they will go to and rotate into is actually European equities. So it has been one of the biggest beneficiaries this year. But our investment thesis for Europe is more than just that. We have become more positive on Europe because of the significant policy shifts that have taken place over there and which have also lifted its near-term outlook. So I've just talked about how Trump has been a very strong catalyst to spur changes within Europe in terms of diversification of its trade partners and also the pursuit of reforms. On top of that, Trump's assault on the rule of law in the US has suddenly made Europe more attractive to businesses. Now, Europe is well known for having a lot of rules and regulations. In fact, I think a better word for this is notorious for its excessive bureaucracy. It's just not business-friendly at all. The US, on the other hand, is more flexible, the rules are a bit more streamlined, and there is also a very strong entrepreneurial culture in the US. Which is why between the US and Europe, the preference for businesses is always the US. But things have changed. With Donald Trump now coming in to test the limits of America's rule of law, Europe has suddenly become more attractive. Yes, there are still rules and regulations, but at least there are still clear rules. And these rules are not going to change so easily. What about? You now have Donald Trump in the White House. You now have an administration where rules can change all of a sudden, depending on the president's mood. And you also have a lot of uncertainty right now because of the chaotic policy making. So you, as a business owner, if you value stability and you want to plan ahead, what would be your preferred venue to do your business? Europe is offering stability right now, and Europe has suddenly become more attractive to businesses. So a lot of them are actually starting to look at Europe, to expand into Europe, to hedge against the risks in America. And on top of that, as the US withdraws from global trade, who else in this world can come in to fill the gap? China could be one of them. Europe is also going to play a more important role. Its combined economy is about 20% of global GDP. If you add in UK, it's even bigger than that. And its economy combined is also bigger than China. And it is certainly big and powerful enough for Europe to assume leadership of a new liberal trading order. And another significant shift that's taking place in Europe is actually its stance towards defense spending. With the US now stepping back from European security, Europe has significantly ramped up its defense spending because it now realizes that military independence has become more urgent than ever, with the US abandoning its allies and Russia also posing a long-term security threat. Now, even Germany has voted in favor of a huge increase in defense and infrastructure investment. And this is a significant shift for a country like Germany, because Germany is traditionally well known for its fiscal prudence. It does not like to spend a lot of money. It certainly does not like to borrow money. And Germany has long been opposed to war and the use of violence because of its World War history. And for a country like Germany to now agree to massive spending in order to boost its defense and to protect itself, Germany also recognizes that it needs to protect itself from the long-term threat of Russia. And this big shift in Europe's stance towards defense is going to provide earnings visibility for European defense companies, which is why in recent times, not only have we been more positive on Europe in general, but we have also been advising our clients to consider a tactical position in a European defense ETF, such as the one by Wisdom Tree, which is listed on the London Stock Exchange. Now, besides Europe, we have also been turning increasingly positive on China. And the key reason for that is really because of China's significant shift in its policy stance. After years of abrupt policy changes, after years of cracking down on its tech companies and the private sector, China has now realized that its economy needs the help of its private sector. China is changing its stance. And with Trump now coming in to target China, it has become even more urgent for the government to revive its private sector. And this change in the policy stance is well captured by this picture over here. This is a photo of Xi Jinping shaking hands with Jack Ma. And why is this picture important? This picture is important because Jack Ma is widely seen as the face of China's private sector. And he was also the first to be subjected to the crackdowns 5 years ago. So with these two gentlemen now shaking hands, I think this is the clearest and surest sign that China wants its private sector to do well again. And this is going to be a huge catalyst for Chinese equities, especially for the tech sector. And I think for the tech sector, I think this is a very important, China's tech sector is in a very interesting position right now because not only do you have the government softening its stance towards the private sector, China has also been fast catching up, to the US in terms of its tech capabilities, as seen by DeepSeek's breakthrough this year. So DeepSeek has significantly lowered the cost of building AI models, and this development has caught the world by surprise. So what does this tell us? It tells us that, okay, yes, maybe China is still behind the US in terms of its tech capabilities, but I think the important takeaway from this is that the gap between US and China is actually much narrower than what most people think. That is the main takeaway. So China is fast catching up, okay? Which is why in recent times we have taken a more positive stance on Chinese equities in general because of the significant shift in policy stance. And on top of that, we also advocate a higher allocation to China tech within the digital economy. Now, Japan is another market that you can also consider. We've always been talking about Japan. Okay, if you have been coming for all our events, Japan is one of the main topics that we usually talk about because it continues to be an attractive structural opportunity. Its economy is undergoing a structural transformation from deflation to inflation. And if inflation sustains, this will open up a pathway for stronger economic growth in the long term. And another important trend that is also taking place in Japan is the increasing risk-taking by consumers. So in a deflation, what usually happens is people want to hold cash because the purchasing power of your cash actually increases in a deflationary environment. So there is no real incentive for consumers to want to seek higher returns elsewhere. But in an inflationary environment, the opposite happens because your purchasing power is being eroded. So now you have a real incentive to deploy all your savings into risk assets in search of higher returns so that you can get compensated for the impact of inflation. So again, if Japan shifts from deflation to inflation, the trend that you will see in Japan is a deployment of savings into risk assets, and that includes the stock market. And this will be a trend that will benefit the Japanese stock market. And one area that you want to consider focusing your attention on is the small cap sector, because the small caps are predominantly focused on the domestic economy, which also means they are in a better position to capture the recovering domestic demand in Japan. Now, one thing that I'll just like to emphasize at this point is that we're not calling for an end to US exceptionalism. Okay? We acknowledge that it is under pressure, but US exceptionalism is far from over because it still has its structural advantages over the rest of the world. It still has the world's most liquid and deepest capital markets. It remains an attractive place for companies to do their fundraising activities, to do their IPOs. And with Donald Trump coming in, I don't think he's going to significantly change that. The US is also home to many companies that hold dominant positions, not only in the US, but also in various international markets as well. And is Donald Trump going to change that? Are you going to stop using Google because of Donald Trump? Is the world going to stop using NVIDIA chips because of Donald Trump? No. Donald Trump is not going to change that anytime soon, in the foreseeable future at least. So this is an advantage that the US has. And the same goes for the US dollar. It may continue to face headwinds in the near term, but it's unlikely to lose its dominance anytime soon, simply because there are currently no other currencies out there that is even close to overtaking the US dollar. This is my last slide. Okay? Just to sum everything up, and back to my first question, is the world entering a sell America era? The answer to that is no, because US exceptionalism is still intact. which also means that US equities will still be central to global equities. So it is important for you to still maintain exposure to the US equity market. It's just that in this current environment, we find that non-US equities are actually more attractive. Other markets outside of the US, they offer more upside potential, which is why we recommend investors to underweight the US and consider allocating to other markets like Europe, Japan, and China. And for those of you who are considering investing in US, just stick to the digital economy and the semiconductor industries. And with that, I end my sharing today. Thank you so much for your time.